First of all, just talk us through exactly who is now allowed to reopen their doors in Germany this Monday.
Well, Thomas, retail stores that have up to 800 square meters of space are allowed to reopen, as are car dealerships, bike shops, and bookstores, regardless of their square meter space. Now, it's no coincidence that car dealerships are among the first in line to get back to business. The auto industry is critical to the German economy. It employs around 850,000 people. The car sales, of course, have been tanking in Germany as elsewhere. March's figures for the country were down 38% from last year. And keep in mind, there were only about 10 days of shutdown in March, so we can expect April's figures to be even worse. Now, the retail sector in Germany that's starting to reopen today has been devastated by the shutdown. German retailers say they've lost out on an estimated 30 billion euros in sales in just a month. So getting back to business is good news for those that are able to do so. Now, one sector that is set to stay closed for the time being is hospitality. That's hotels, restaurants. A leading trade group said Sunday that around 70,000 businesses in the industry are looking at bankruptcy, and those companies will have lost around 10 billion euros in sales by the end of April, and there's nearly 250,000 jobs at risk there. Officials told German newspapers Sunday that the government is likely to target some more aid to hotels and restaurants, either in the form of lowered VAT tax or just in straight grants. Now, the country's already passed a 1.1 trillion euro rescue plan in late March, so chances are good that there will be more to come. Germany, of course, has been less badly hit by the coronavirus crisis than, say, other European neighbors like Italy, Spain, France. The Germans believe they have the outbreak, quote, under control, but it's obviously still going to be a long road to a complete economic reopening.
Bryan, let's move on now to the global oil markets. We're seeing US crude prices falling to over 20-year lows. What more can you tell us?
Well, Thomas says Brent crude is the European standard. It's down just a few percent Monday. But as you say, the real carnage is on the U.S. crude oil futures markets. West Texas Intermediate futures currently down over 21%. Basically, it comes down to supply and demand. The simple fact is that the one is very high and the other is very low. Last week saw a tentative deal reached between the OPEC cartel led by Saudi Arabia and allies like Russia. They're planning to cut production by around 10 million barrels per day for the next 2 months. That's equal to roughly 10% of global supply. It's a huge number. The problem, of course, is that global demand is down by over 30%, much huger number. Planes are not flying, people are not driving, factories shut down. The demand just isn't there. So what you have is crude oil piling up in storage facilities. And in the U.S. especially, those facilities are getting close to full capacity. The U.S. oil industry, particularly shale gas, which is very big in the U.S., has been very hard hit by falling prices. Shale gas is more expensive to pump out of the ground than other forms of crude. So at prices like these, basically every U.S. provider is operating at a loss. It's already having major consequences for the industry, and we will be seeing more in the weeks to come.